Hey, what's going on, guys? It's Marco. So I think it's no surprise by now that things are not going too well with the economy, especially with inflation running at over 8.3%. Many people, including myself, already can see that we are in a recession. And if you've tried buying a house so far this year, it really hasn't been too easy. You see, home prices are still sky high, rates are hovering at nearly 7%. Being able to afford a house hasn't been this bad in a very long time. But does that really mean that you should stay away from buying real estate right now because a housing recession seems to be incoming? Look, today I'm gonna talk to you guys about how to take advantage of the real estate recession that we are in or about to face, why this may be the best time to buy, and how you can still come ahead. Now, this has been a pretty tough year if you have thought about buying a house and finding a good deal. Whether you've been looking for a house for you to live in, or if you're an investor looking for that next cash flowing property, or if you are looking for a home to flip. You see, at the beginning of the year and really through the start of the summer, it seemed like home prices wouldn't stop rising. The June national median listing price hit $450,000, and that was up 17% compared to the year before. Now, meanwhile, mortgage rates have increased by more than 3 percentage points in the first 9 months of 2022, pushing the monthly payment on a median price home up nearly 50%. And just to give you some context, at the very beginning of January, your average 30-year fixed rate stood at just 3.5% compared to a 17-year high of about 6.5% right now. So if you had taken out a loan for, say, $500,000 with a 3.5% rate, your monthly payment would be roughly $2,245. Now compare that with a 6.5% rate and you're staring at a $3,160 payment every single month, or a difference of over $900 a month. And you couple that with the fact that the stocks are in a bear market, the country just registered 3 straight quarters of negative GDP, which is the textbook definition of a recession, even if they want to change that definition.
Not redefining recession.
But even the Fed has said that for the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, in a reasonable pace, and that people can afford houses again. Now, we probably in the housing market have to go through a correction to get back to that place. So even though the Federal Reserve is purposely trying to get the housing market into a correction, does that really mean that a housing crash is coming? Obviously, when we think of a housing recession, we think about the 2008 housing crash for basically everybody, right? For those who lived it, for those who maybe just read about it. But see, guys, there are some pretty big differences between now and then. Because before 2008, lenders were offering subprime mortgages to pretty much anybody with a heartbeat. These loans were given people with bad credit scores, no proof of income, no down payment, and a low teaser rate for the 6 months or 12 months of the loan. Now, that obviously led to a soaring demand for homes, which made prices skyrocket. And when these borrowers were unable to make those payments, they simply walked away from their home. I mean, look, they have very little reason to stay because, one, they had no skin in the game. When people buy houses with no down payment, they just simply get to just walk away with no harm. Now, obviously, the demand for houses plummeted, which also meant a significant drop in equity and prices, and that happened to pretty much every homeowner across the country. So on top of it, the financial institutions that were holding these mortgages were unable to collect on these loans, and that led them to file for bankruptcy. But see, since then, many regulations and policies have been put into place to prevent risky loans for less than qualified people with bad credit scores and with no money, and obviously without sufficient proof of income. And kind of like nowadays, virtually everybody who buys a home is well qualified because most people have to put a down payment on a house, their credit scores are in good shape, and they make a sufficient amount of money to qualify. And look, prices of homes have been steadily going up since 2013, but the big surge of the last 2 years were caused by the government itself pumping trillions of dollars into the economy to keep rates down. I mean, look, when you're giving people the opportunity to take out massive loans at a 2%, 3% interest rate over 30 years, it doesn't really take a genius to know what was going to happen. So if you are thinking that some sort of real estate crash is coming, the last 2 years alone have caused home equity levels to reach the highest levels ever. And in fact, the average homeowner who bought a house over 5 years ago is sitting with nearly $300,000 of equity in their properties. And the other reason why home prices might actually stay afloat is because despite the market cooling off, we are still in the middle of a severe housing shortage. Because see, what happened is that for a decade, following the 2008 crash, builders didn't build enough homes. They were sort of always being cautious of the next housing crash. And today, homes are still getting bought up and put under contract in record time. New homes that go on the market just last about 16 days on average. But look, with that said, Moody's Analytics recently downgraded their housing market outlook, expecting home prices to fall between 0 to 5% and fall between 5 to 10% in significantly overvalued housing markets. Now, that August forecast assumed no recession. So if an economic downturn did come into play, they expect home prices to fall between 5 to 10%, while significantly overvalued housing markets will fall 15 to 20%. But look, let's say that home prices do decline 15%. Well, that drop wouldn't really erase the 43% jump that we've seen since 2020. Anyways, now that I just gave you the whole picture of what's going on, let's talk about why a recession could be a good time to buy. First off, you can actually negotiate with someone selling their home. Because for the past 2 years, it's been the best sellers market in history. Sellers have loved bidding wars over their homes, with buyers paying above asking prices, waiving contingencies such as inspections, appraisals, and even offering to name their firstborn child after the seller. Now, during a recession, home prices usually decrease as the demand slows. Now you start to see home sellers get a little bit anxious at the fact that their home hasn't been sold and it's been on the market for 30, 45 days with no offers. And this obviously opens up the possibility of buying a much more affordable home, or simply by having the seller contribute to your closing costs, or obviously by putting those contingencies back into your contract. Now you can kind of get an idea by scrolling on the Zillow app and cheerfully see all of the price drops in your area. Now the second reason why buying a home during a recession is because interest rates and mortgage rates will eventually go down. So as inflation does go down at some point in the future, the prices of existing bonds being sold with the higher yields right now will likely go up, which in turn may affect interest rates. And when we hit a full-blown recession, the Federal Reserve will try to stimulate economic activity by reducing the Fed funds rate or the interest rates that banks charge each other for overnight loans. Look, I know right now it doesn't seem like a great thing to buy a home with a 7% interest rate, but don't make a decision based on it only. Real estate is so cyclical. If the right opportunity does present itself to buy the dream home you always wanted or a great investment property, just go ahead and take it, because you always have the option to refinance your mortgage at a lower rate down the road. And finally, the third reason why buying a home during a recession is because there is less competition, which means more options, more choices for home buyers. Because as the housing market does cool, more potential buyers step away from the market. Now, during a recession, some people may be laid off or be fired from their jobs, or simply they just fear where the economy is going, so staying put and playing it safe seems to be the best course of action for them. Now, this reduces the foot traffic at open houses, the amounts of offers that a seller can get, etc. And unfortunately, there will also be the homeowners who have to sell for financial reasons. This adds even more supply to the market. So whether you want to get into real estate because you need a place to live, or truly because you want to make it into an investment, honestly, having your goals defined needs to be the number one thing that you gotta keep in mind. Because even if the market does come tumbling down, fact of the matter is, guys, people still need to put a roof over their heads. And as a real estate investor, I know that 100%, because the demand for rental properties tends to remain steady, and sometimes it can even rise during a recession. And if there's a limited supply of houses to go around, property investors are typically better positioned to be able to count on a steady stream of rental income. And look, unless you are flipping houses, real estate is a long-term play. And finally, real estate can also act as a hedge against inflation in the event that this recession does become stagflation. And stagflation happens when we have both high inflation and high unemployment. Now, real estate prices do tend to keep up pace with the higher consumer prices, which makes it one of the best inflation-proof investments out there. That is it, guys. Hopefully you liked the video. Let me know what you think in the comments below. And if you did like it, go ahead and give it a thumbs up. And if you want to learn more about real estate financing strategies, and more, go ahead and check out some of my other videos and hit that subscribe button below. Thank you so much for watching. See you on the next one.